We caught up with you 10 days ago. Mester and Bullard opened the door to 50 basis points. Is this a crack in the dam at the Fed?
It seems too soon to be seeing you again. It was virtually last time. They should be quite pleased with themselves, because if their objective was to shift the forwards or to move the market at least to their way of thinking, they've done it. So it's kind of job done. The market's pricing what they wanted to see in December. Back in December, you had the dot plots, you had complete visibility. I doubt the March dot plot's going to be hugely different. So they should be quite happy that it's a job well done. It took them a while because the bond market was going the other way for the first 4 or 5 weeks of the year, actually since last October, but they've pushed it back to where they wanted.
How much more room for correction do you see in the bond market? Because you talked about the sell-off. It's more of a correction than a sell-off, but do you think that there's more downside here before it kind of stabilizes?
Well, to me, it's a correction.
Yeah.
So it's a correction in a longer-term decline in the bond yields that's going to re-establish. Others might think this is just part of the bear market as yields go higher and higher. So that's quite interesting, because you've got a healthy tension between two big views here, and the bond market's kind of stuck in the middle of that. In answer to your question, the way the market's setting up at the moment is for a kind of tabletop mountain. So you get to a peak and then you have a plateau. So it isn't actually a peak, it's a plateau. It stays there for a long time, but it comes down the other side quite sharp as well. If you just imagine that actual tabletop mountain in South Africa, my understanding is it's quite steep on both sides and it's very flat at the top. But of course, it looks flat from a long way away, but when you're there, it's quite bumpy. So that's sort of what it's like, right? We're in the bumpy bit.
We're in the bumpy bit, but as you say, we're going to go into glide path at 40,000 feet or thereabouts. Yeah. Right. Now, you've often talked about inflection points, and you've talked about the speed. Yeah. You're very interested in the speed. So we hit this mountain top, let's say, to the mid-5s. Yeah. You're still rooted in the case that the market will return to around 1-2%. I'm being disingenuous to your call. No. But how quickly can it turn? You need something to turn this around, and that's long, variable lags, isn't it? We need to see something really substantial on the downside in the economy. Yeah. We haven't got it.
You're getting to the essence of the debate, Manus, because for me it's a leap of faith. Right, I cannot tell you the trigger point, the day, the event.
I know.
And you see, the rational thinking economists and those at the Fed, they need to see it in the data. And that's how they work. They've got to have confirmation. They're in risk management mode. They have to be very careful, and they will be late. They'll be too late, right? Now, we in the market have to be preemptive. Now, I know that we've got the long variable lag from the previous tightening. The real rate went up a lot. The curve is inverted. Mm-hmm. Some of the forward-looking indicators are pointing to the downside. And so it's a leap of faith, but you have to go with it, because rates are going to hit a peak. They'll stay there for a while, and granted, it looks like it's going to be a bit longer than we originally thought, but they're coming down again. Yeah. And for a bond investor, if it's so obvious that the money market is attractive and you put all your money at 5%, say, well, that's all very well, but what happens when it turns? Mm-hmm. You would have missed it, and that's the opportunity cost of going for the optics of the high money market yield, which is very, very appealing intuitively, but it's not particularly robust from an investment point of view.